So 2019 was a very tumultuous year for the RBA after 34 months of no cash rate cuts at all, and us struggling to find something to write or talk about. They cut the cash rate 3 times in 2019, going from 1.5% to 0.75%. So what impact will that have on the market? How will that change what people are paying on their home loans and making on their savings? And will this mean that the house price jumps we've seen in Sydney and Melbourne will continue on in the future? We'll cover all of that and more in our roundup of 2019. So while the RBA slashed the cash rate by 75 basis points, when we look at the average owner-occupier variable loan offered by the big banks, those have come down too, but they've only come down by 57 basis points. So it means that banks have kept almost 1 in 3 of the cash rate cuts to themselves and have not passed it on. So how much will that make a difference for people who are borrowing? Well, the average variable rate across the big 4 banks now is 4.80%, but they haven't passed on the full interest rate. If they did, that would be lower, and we reckon by our calculations that this would save somebody who bought the average house in Australia about $26,000 over the 30-year course of a loan. So, there's a certain amount of money the banks are definitely taking in that they are not passing on to consumers here. Having said that, there's better rates to be had in the market. Right now, there's many lenders, some of which we're displaying on the screen here, which are offering rates of 3% or below in the market. Now, 3% will save you about 240k above the standard variable rate that banks are offering. So the big savings are in the smaller lenders. So what's the impact on savers? Well, as we know, the RBA cut by 75 basis points. We saw the banks pass on only 0.45% to the average online savings account in Australia. Now that's interesting. It looks like the banks are actually not passing on the full cut and giving a bit more to consumers to make on their savings. But actually, if you look a little bit deeper, before the cuts even came in, the standard interest rate that savings accounts in Australia were offering was only 0.85% anyway. So if the banks had passed on the full cut, that would drop to 0.1. People would be basically making nothing on their old-fashioned savings accounts. Banks couldn't really do that. The big interesting thing is the reason it was so low before the RBA cuts started happening is that banks have been chopping the interest rate on standard savings accounts and increasing it on bonus savings accounts to push people into those products where your money's more deeply locked in and banks have more certainty of those funds in their account. So that's why we've seen that change. If you look at the bonus savings accounts separately to the online savings accounts, we've seen the rate on those drop by 65 basis points, 0.65. So more has been taken away from those accounts. If you're looking for more detail here, we have a separate video looking specifically at savings in the market in Australia, explaining all of this. You can check out the link to that in the description below. So the third thing we're going to look at here is credit cards. How much of the cash rate cut have banks passed on to people with standard credit cards in Australia? Well, 75 basis points cut off the cash rate. What's been passed on? The interest rate for standard credit cards in Australia has gone up by 0.08%. Banks are charging more for credit cards on average. This one's interesting. We used to see the standard credit card interest rate go up and down with the cash rate like we still see home loan rates and savings rates do. And that used to happen continuously up until about 2010. And then there was some change in the market where the interest rate for credit cards has sat pretty flat since then, and the cash rate has dropped through the floor. So banks are no longer passing savings onto credit card customers. One of the reasons is we've seen a divergence in the credit card market. There's more specifically low rate products in the market for credit cards. In that particular group, we have seen banks pass on a savings cut. The banks in that group have passed on about 30 basis points in savings, so only a small portion of the cash rate cut. Of course, if you do have a card, the advice here is always pay that card off at the end of the month. If you do that, the interest rate should not matter. But if you're in any way lacking in discipline, you need to make sure if you're gonna get into having a card, you have a low interest rate. So in conclusion, those are the changes we've seen in the market following the 3 cash rate cuts this year. Now, we've seen as a result of that, we've seen house prices go up quite dramatically in Melbourne and particularly in Sydney over the last kind of couple of weeks after they dropped previously. We asked the economists that we survey what they think the main driver behind that is, and 87% of them said the house prices are going up because the cash rate is coming down. So cash is cheaper to borrow people are able to borrow more and people are basically jumping on the housing market. Fear of missing out is kicking in as prices are going up. More people are getting in, those prices are accelerating. So with all of this in place, all this bubbling along, what impact is this going to have on the market next year? Will we see more cuts? Will we see house prices continue to increase at the same level? What other impact will affect the economy in 2020? We have a second video to go along with this, looking at the forecast for 2020, which you can check out in the links below.